Let's look at what's actually happening. In 2007, a hedge fund manager named Michael Burry placed a bet that everyone in finance told him was insane.
Tom, how much of this is just Michael Burry confronting with a market that's incredibly hard to bet against?
He bet that the US housing market, the largest, most stable asset class in the world, was about to collapse. And when it did, his fund made over $700 million. He did not own a single share of a falling stock. He didn't predict the future. He used a financial mechanism that has existed for over 400 years, one that most retail investors have heard of. Very few actually understand, and even fewer know is now accessible from any standard brokerage account. It's called shorting. And by the end of this video, you'll understand exactly how it works, the three mechanisms hedge funds actually use, and critically, the risks that almost nobody explains properly until it's too late. If you've only ever bought stocks, you only know half the market, the half where you make money when prices go up. But every market, stocks, real estate, crypto, currencies, moves in two directions. And there's an entire profession built around profiting from the direction most retail investors never touch. Understanding shorting doesn't mean you have to do it, but not understanding it means you're only playing half of the game. So let's break down how it actually works. The original method has been around since at least 1609, when traders on the Amsterdam Stock Exchange figured you could profit from a falling stock without owning it. The mechanic is counterintuitive at first, but the logic is simple. Here's how it works. You borrow shares of a stock from your broker, shares you don't own. You immediately sell them at the current market price. Then you wait. If the price drops, you buy the same shares back at the lower price, return them to the broker, and pocket the difference. If the stock fell, you profit. But if it rose, you lose. Take a real example. A trader believes a company trading at $100 per share is overvalued. They borrow 100 shares and sell them immediately for $10,000. 3 months later, the stock drops to $70. They buy back the 100 shares for $7,000, return them, and walk away with $3,000 in profit. They never owned a single share for more than the seconds it took to sell them. Now, here's what most explanations leave out. When you buy a stock, your maximum loss is 100%. The stock can only go to zero. When you short a stock, your maximum loss is theoretically unlimited. There's no ceiling on how high a stock can rise. If you short a stock at $50 and it surges to $500, you owe the difference. The 2021 GameStop short squeeze made this brutally real for several hedge funds. Some lost billions in days because the stock kept climbing and they were obligated to keep buying back at higher and higher prices. This is the trade-off shorting demands. Asymmetric risk. Limited upside, potentially unlimited downside. Anyone who tells you otherwise is selling you something. The second mechanism solves the unlimited loss problem of classic short selling. It's called buying a put option. A put option is a contract that gives you the right, but not obligation, to sell a stock at a specific price by a specific date. You pay a premium upfront. So if the stock drops below your strike price, the option becomes valuable. If it doesn't, the option expires worthless and your loss is capped at the premium you paid. Take the same example. A trader thinks a $100 stock is overvalued. They buy a put option with a strike price of $90, expiring in 3 months. The premium costs $3 per share, $300 for a 100-share contract. If the stock falls to $70, the option lets them sell at $90, capturing $20 per share in value. After subtracting the $3 premium, that's $1,700 in profit on a $300 bet. If the stock doesn't fall, they lose the $300. That's it. The maximum loss is known the moment they enter the trade. This is how Michael Burry actually structured his 2008 bet. He didn't short housing directly. He bought what are called credit default swaps, which functioned like put options on mortgage-backed securities. His maximum loss was the premium he paid. His upside, when housing collapsed, was massive. Defined risk, asymmetric reward. Most retail brokerages, Fidelity, Schwab, Robinhood, eToro, now offer options trading after a basic approval process. The mechanism that made Burry $700 million is technically accessible to you. The catch is that options have their own complexity: expiration dates, time decay, strike pricing, and the learning curve is real. The third mechanism is the one almost no one talks about because it's the simplest and it doesn't require options approval, margin accounts, or any specialized knowledge. It's called an inverse ETF, an exchange-traded fund engineered to move in the opposite direction of an index. If the S&P 500 drops 1%, an inverse S&P ETF rises 1%. You buy it like any normal stock. No borrowing, no options contracts, no margin calls. The major inverse ETFs include SH for the S&P 500, PSQ for the Nasdaq, and DOG for the Dow Jones. There are also leverage inverse ETFs, funds that move 2 or 3 times the inverse of the index, but those carry significantly more risk because of how they are structured internally. Now, here's what nobody mentions about inverse ETFs. They are designed for short-term hedging, not long-term holding. They use complex daily rebalancing mechanics. And over time, that rebalancing causes what's called volatility decay. The fund's value can erode even when the underlying index moves the way you predicted, just because of how the daily resets compound. If you hold an inverse ETF for a week and the market drops, you profit. If you hold it for a year through a choppy market, you can lose money even if the index ended lower than where it started. That's the fine print most beginner guides skip. Now, some of you are probably thinking, isn't shorting just betting against the economy? Isn't there something morally questionable about profiting when others lose? Fair question. An honest answer? Short sellers serve a real function in markets. They're often the first to expose fraud, overvaluation, and structural weakness. Enron, Wirecard, Lehman, short sellers were warning about all of them years before mainstream analysts caught up. Without short sellers, prices reflect only the optimistic view, which historically inflates bubbles to the breaking point. The market needs both directions to function properly. That said, here's how to think about which mechanism, if any, fits where you actually stand. If you're a beginner with a long-term portfolio, you probably don't need to short anything. The simplest hedge is diversification, holding assets that move differently from each other: bonds, gold, international stocks, defensive sectors. That's a far better risk reduction strategy than active shorting for someone whose primary goal is long-term wealth building. Skip mechanisms 1 and 2 entirely. If you ever want exposure to a downturn, mechanism 3, inverse ETFs, for short-term hedging is the gentlest entry point, but only with money you can afford to lose, and only for weeks at a time, not months. If you're an intermediate investor with a defined thesis, put options, mechanism 2, are the right starting point. Defined risk, no margin calls or prices. They let you express a directional bet without putting your portfolio at unlimited risk. Start tiny. Risk no more than 1 to 2% of your portfolio on any single options trade until you've traded through at least one full market cycle. Most retail options traders blow up not because they're wrong about direction, but because they're wrong about timing. If you're experienced and have a multi-year track record, classic short selling, mechanism 1, becomes available. But with one rule: never short something just because it's overvalued. Markets stay irrational longer than you can stay solvent. A phrase widely attributed to John Maynard Keynes, who'd know having lost money making exactly that mistake himself. Short for specific falsifiable reasons: fraud, structural mispricing, unsustainable cash flow, and always with a clear stop loss. Here's the number that frames all of this. In 2008, while the S&P 500 lost 38%, hedge funds running short strategies posted positive returns. Some made over 20% that year. Same market, same crash. Opposite outcomes. Not because they were luckier than the people losing money, but because they understood that markets move both directions, and they had position for it. That's the real takeaway. Not that you should rush out and short the market, but that the financial mechanism most retail investors think of as exotic, dangerous, or inaccessible has been operating in plain sight for over 400 years, and is now technically available from any brokerage account you already use. Knowledge is the prerequisite, action is optional. But the people who understand both directions of the market, even if they only ever trade on one of them, navigate downturns very differently from the people who don't. Do one thing this week. Pull up your brokerage account and look at whether options trading is enabled. Look up the ticker SH and watch how it moves over the next few days relative to the S&P 500. You don't need to trade anything. Just watch the mechanism work in real time. Once you've seen it, you'll never look at a falling market the same way again. Tell me in the comments, have you ever shorted a stock or bought a put option? What happened? I want to hear both the wins and the lessons. If this gave you a clearer picture of how the other half of the market works, subscribe. We break down the hidden mechanics behind modern markets every week. None of this is personal financial advice. It's education so you can build your own framework and make decisions that fit your life.